Hello, Matthew Copley here with Copley Financial Group, and we're going to do a market update today, talk a little bit about what's going on in the economy, what we're seeing as far as the investments, and just some interesting information that we can share with you. Number one, I'd like to talk about our client appreciation dinner that's coming up on January the 30th. Most of you have already signed up. If you have not yet, feel free to reach out. We do have some space available for people to come to that event. If you have someone you'd like to bring along, that's certainly an option as well. Just reach out to our staff. It is a pretty big event. We will have over 500 people at that event, and we should have some good information. We're actually doing some unique things this year. This year we're going to have primarily just myself and one other speaker talking about the economy and what they see as far as markets going forward. In addition to that, we have some sponsors this year, which has been a really nice thing to have. And these companies that are sponsoring the event are helping us with some of the cost. And we're going to highlight some of the different investment opportunities that these different companies offer. And so these are companies we kind of handpicked that we wanted to be part of the event. They're also helping sponsor the event. And this actually triggered something that we had to send out just recently, is a conflict of interest disclosure. So you got an email. There's nothing you need to do with that email, but since some of these people are helping us in paying for the client appreciation dinner, we had to send out a conflict of interest disclosure to let you know that these people are providing us with some additional funds to help us with our client appreciation event. As far as what we're seeing in economic data, currently it's very mixed. There is a lot of data out there showing that we are already in a recession or we're going into a recession. Some of the numbers are very, very questionable that are coming out of the government as far as the data. For example, the jobs data says that everything's great. We came in with a much higher jobs number than was expected on Friday last week. And when you dive into the numbers, it's a lot of government jobs. And so the problem with government jobs is they don't really help with the economy. In fact, some might say they take away from the economy because more government workers puts a problem, a drag on economic development in the private sector. And so looking at it from the standpoint of history, going back to like the 1930s when unemployment levels were very high during the Great Depression, government jobs were not part of the equation. And of course, everyone who was unemployed was counted. Today, government workers are part of the equation. And of course, we talked about this in a previous video where we changed the unemployment reporting from the U6 to the U3. Used to just be unemployment. Now they have the U6 and the U3, which we talked about. You can certainly look at a previous video that we did on this and learn about the difference between the unemployment rates and what we're seeing. So the data is mixed. The jobs data obviously looks decent. Looking at some of the debt that we have, everyone's worried about the U.S. debt. I'm not that worried about the U.S. debt. We're talking about $35 trillion in debt. About $10 trillion of that is owned by the Federal Reserve and other U.S. agencies, other parts of the U.S. government. So it's not that much debt overall compared to the size of the economy. Our debt is far less on a percentage basis compared to many countries around the world. I am concerned about the deficit. And so there's a difference between the debt and the deficit. The deficit is the amount of money we have to pay every year servicing that debt. And with the interest rates a lot higher than they have been in the past, the interest on that debt is quite high. The government has to figure out a way to reduce government spending because we are now paying a lot more in interest on that outstanding government debt. There's a lot of hope that maybe a new administration is going to help reduce some of that government waste and government inefficiency. However, I'm not that excited because I know how politicians promise a lot of things and then it ultimately does not get delivered. First, they have to go through other Congress and the Senate, and at the same time, you have to look at whether or not they actually want to complete their promises, right? A lot of times you'll hear, oh, there's going to be no tax on Social Security. There's going to be no tax for tips. And these may have been campaign promises. We'll see if it actually comes to light. So looking at a lot of the economic data that we're seeing, there is one thing that I want you to understand that I think is different than most analysts will tell you, and that's inflation. Inflation is going to be a lot worse than they're telling us, and this is the one area where we want to make sure our investments are set up correctly. Inflation is something that you look at from the standpoint of monetary growth, and not so much prices going up. Everyone gets confused and thinks that inflation and consumer prices going up are the same thing. They're not. Inflation is the increase in the money supply. Consumer prices are the result of all of that inflation. So looking at the actual inflation rate, the government is still printing a lot of money out of thin air. They're still expanding the balance sheet. They're still expanding credit. We're seeing a lot of government spending. So I do think inflation is going to ultimately be a lot worse than they're telling us. And we're starting to see that in some of the data. Now, the current CPI says inflation has come down. It's low. And this is like the CPI, the Consumer Price Index. But that is what's called a lagging indicator. It's important to understand the difference between leading and lagging indicators. A lagging indicator is like unemployment, is the CPI. You're kind of seeing it at the end of the line. When you look at inflation, we want to start looking at the leading indicator. So one we might look at is the PPI, which is the Producer Price Index. This is the actual amount that's being spent by businesses before it ultimately gets to the consumer. Now, the PPI has actually been on an uptrend, and that is a bad sign for inflation. But even before the PPI, which by the way, the PPI will come out tomorrow. We're recording this on Monday. And so we will see what the PPI data is tomorrow. I do expect that to come in hotter than expected. But even if it doesn't, let's say the PPI comes in great, it's a cooler number, no problem. Well, maybe a week, maybe a month, maybe 2 months from now, we're gonna see data coming in a lot hotter than expected. And a lot of this has to do with what goes into the PPI. And the number one thing there is commodities. And so when we look at commodities, how much are commodities prices up over the last year? This is everything that goes into those producer price indexes. So soybeans and coffee and copper and iron and all the different commodities out there. And looking at the data, it's actually pretty frightening. The cost of commodities is up over 20% in the last 12 months. And so this is everything that goes into everything that we make, including oil, including copper, all the things that is inside all the products we consume. And so commodities prices are way up. And this is in the face of a US dollar that's been very strong against foreign currencies. So other countries around the world have been struggling. Countries like China are in real trouble. The Chinese economy is a disaster. Their whole real estate market has crashed over 30%. They're seeing like what we had in 2008 is going on in China right now. Huge employment problem in China. Lots of bad economic data. They've already taken interest rates down to ridiculously low numbers, which is kind of a big red flag when we're seeing that the Western world, the Europeans, the United States, and we're actually seeing interest rates going up, and at the same time, China's rates are crashing. So China's in real trouble. So this would actually cause commodity prices to drop. In fact, if China is struggling, they're not buying as many commodities to manufacture goods because their economy is down, we would expect commodity prices to be lower, not higher. But in fact, when we look at actual commodity prices, they're up over 20% in the last year. So that means in the face of all of this Chinese problems with the economy there, that we're still seeing higher commodity prices. That tells you just what inflation looks like. And if the Chinese get their act together and their economy starts to build back up and they start getting more demand for commodities, things like copper and oil and things like that, you're going to see commodity prices really take off. And so we want to make sure that we're positioned the right way with all of our clients, understanding that we are seeing more inflation, and not just with commodities, but we want to look at real estate, we want to look at agriculture, we want to look at energy, we want to look at gold Everyone thought I was crazy when I said gold's going to $2,500 an ounce at the end of 2024. And I said that at the beginning of 2024 when gold was actually $2,000. And everyone was saying, no way, there's no way gold's going up another $500. That's a 25% move. That's too much. Well, it actually went to $2,700. So it went even higher than I expected. And the recent slowdown in gold, we have seen gold pull back. A lot of it has to do with some of the Trump winning the election and people thinking that he's going to help get the government under control as far as spending and efficiency. I disagree. I think the spending is going to go up regardless of whether it was Kamala Harris or Trump. I think that the spending was going to go up anyway. Now, maybe Trump will be less spending than Harris would have been, but the spending's still going up. This is going to be inflationary. So when you start seeing the future, and we look at what's going to happen, you have to understand that if inflation's going up, we have some economic data that's questionable. I believe that the recession was actually happening, and I've said this for a long time, that the summer of 2024 is when I expected the recession to hit. And we obviously have seen a lot of data. There's a lot of questionable numbers as far as, 800,000 job revisions to numbers. We're seeing big revisions to some of the economic data that's out there. Are we in a recession now and they're just not admitting it? I don't know. Looking at the data, it says that we may have gotten past the recession, but looking at going forward, we have to look at whether the market is expensive or whether the market is inexpensive. And this is something important for financial advice, for you to look at your own investments. And really, doesn't matter what happens with the economy as far as is it growing, is it contracting, is it a recession? Is it expensive? And the answer to that is a resounding yes. The market is expensive. When we look at valuation metrics, whether it's a PE ratio, PEG ratio, CAPE ratio, you look at all of the ratios that are used, where it's the market value of the stocks, all of the equity valuations versus the gross domestic product. This is one of Buffett's favorite indicators. It all says the stock market's expensive. Now, that doesn't mean that the market can't keep going up. We can make some really good returns on the stock market, even at the current levels. In fact, in 1998, when the CAPE ratio hit 35, the market kept going up for another year and a half. But you got to understand, when the market's expensive, you want to be more cautionary. You want to be more conservative in your investments. You want to look for value versus growth. You want to look for dividends. You want to look for free cash flow. You want to look for things that help protect you. And this is where some of the investments that we have our clients in are going to provide that with some potential upside. But in case things go against us, we have this protection in place because we have some guaranteed interest rate, or we have some buffered index portfolio, or we're focused on value stocks. And so whenever you have that situation where the market's expensive, you want to take action. Now, a few years ago, if the market's expensive, the alternative was you get 1% in a savings account if you're lucky, or even in a CD. The interest rates are super low. Today, we actually can get 5.5%. So the alternative is not bad. So there's not a lot of reason to take too much risk at this point, because we do have alternatives that have some decent interest rates. And not just in the public markets, we're seeing a lot of opportunity in the private markets as well. Obviously, if you want to invest in the private markets, you have to be an accredited investor, which means you have to have $1 million in net worth outside of your primary residence. We got to be able to document this. But if you do qualify as an accredited investor, there's some really amazing opportunities in real estate, all kinds of different real estate investments, oil and natural gas investments, a lot of different opportunities that are out there where the rates and the returns are quite high compared to what they have been in the past. So 3 areas that I want to mention besides the alternative investments, which obviously are a great thing to take a look at now if you qualify. Other areas is value stocks, and we have a company that we are working with now. It's kind of an exclusive thing where they don't work with too many financial advisors around the country. They just work with specific registered investment advisors that they want to work with. We're one of them here in San Diego. In fact, I don't know of any other company here in San Diego that is offering their investments, and that is Alpine Capital Research. They have a phenomenal 20-year track record of getting great returns in the stock market. And so they actually invest in stocks, but they focus on companies that are undervalued. They look at companies that they believe are 20% undervalued compared to what the current market valuations are. Companies with good valuations, good dividend yields, high quality stuff, and not just here in the United States, but they're looking at companies internationally as well. Companies that have really good balance sheets, good cash flow, and they have just beaten the tar out of all of the benchmarks in their categories for over 20 years. And they actually focus on value companies. And this is a really good time to do this. In fact, between the year 2000 and 2010, they averaged a return that was above 10% average per year. And the S&P 500 was flat. I mean, from 2000 to 2010, it went nowhere. You had the market go up, 2008 crash, came back, and we were basically just where we were 10 years before in the year 2010. And Alpine Capital Research in that time frame actually had a 10% annualized return. So these are the kind of companies that we want to focus on at this point. So that's one that we are looking at. We've repositioned a lot of our clients over there already. We're looking at when we do reviews on our client accounts, can we get some funds transferred? It is an exclusive investment. It does require a $100,000 minimum investment. And so we want to make sure that you have the ability to have that much in one investment. So obviously for some of the clients that have more money, assets under management with us. Obviously, the buffered index is something we love. It's produced phenomenal returns. The current one we have available is a 22% cap, and this is just investing in the S&P 500. So you're putting your money in the S&P 500, and it can go up to 22%. So if the stock market is up 10%, you're going to be up 10%. If the market's up 15, you're going to be up 15. If the market's up 22, you're going to be up 22%. It is a 2-year investment, so you hold it during that term. If the market's up more than 22%, say the S&P 500 is up 30%, you are only going to be up 22% because we're agreeing to give up everything above 22. In exchange, we're able to buy a really nice dual directional insurance policy of 15%, which means if the stock market goes down, not only do you not lose money, you actually make money all the way down to 15%. So if the market, say, was down 12%, not only do you not lose, you make 12%, the opposite return. So that's a really, really good protection in the account. Now, it does have a 15% maximum reimbursement. So in the event that the stock market, say, was down more than 15%, you just get a 15% reimbursement. So if the market was down 20%, you'd get reimbursed 15, you'd still be down 5%. So that's how that buffered index works. We negotiate new ones every few weeks, and so the one that is available right now, we'll be finishing up funding on that in a few days, but we'll have another one that is coming, and we negotiate these every few weeks. And so you can call and ask what the current numbers are, because I imagine when this video comes out, it'll be right about the time we're looking at a new buffered index portfolio. In addition, we like the guaranteed interest. So the current MIGA right now is the same number as the last video we did, which is 5.5%. Guaranteed, you can lock that in for 3 years or 5 years. So 5.5% guaranteed every single year for 3 years, or 5.5% guaranteed every year for 5 years. Some people say, well, why would I lock it up for 5 years when I can just do 3 years and get the same interest rate? Well, it's because it locks it in. If interest rates were lower 3 years from now, it'd be kind of nice to have an extra 2 years at 5.5%. Now, of course, the opposite is true. If interest rates are higher in 3 years, well, we would want to go to the new interest rates that are higher in 5.5%. I do not have a crystal ball. I do not know what's going to happen with interest rates. I will tell you, if we have a big recession, it's likely that interest rates will be lower in 3 years. In the event that inflation really takes off even more than analysts expect, we could have higher interest rates. I think it's kind of 50-50 whether it goes either way. I lean more towards the 3-year at this point, just because I do think inflation might end up being worse than analysts expect, and we may have to take interest rates up quite a bit higher in order to get that under control in the future. And I like the idea of you getting all your funds back after 3 years and being liquid for whatever you want to do with those investments at that time. So that's our market update for today. A couple things I want to mention, which is really important. if you need anything from us, whether it's a income distribution or anything, make sure you're including support@copleyfg.com on all of those emails. It's important because we have a lot of stuff going on here in the office. I am out of the office a lot. In fact, I'm going to a business conference I'm speaking at this week in Austin, Texas. Just gone for a few days and coming back. But I want to make sure that everyone is able to talk to someone and get help if they need it. And so if I get an email, I may not see it for a few days, but if you're sending that email and including support@copleyfg, we can make sure that we're taking care of you as far as any requests that you have. So I hope this was a good market update. And we are going to be doing, by the way, a new video series. You'll get an email on that here shortly with some new videos. We're just going to talk about different specific investment strategies, different things as far as tax reduction, or different ways to invest your money with diversification, and just different topics. We might mention various clients that we've run across. We won't mention any names, of course, but we'll use some case studies, talk about different strategies we've used in the past. And so these will hopefully be some educational, helpful videos for people that might be facing the same situation financially. And so those will be out shortly. So look out for that email, and hopefully you'll be able to watch those videos as we put them out. We actually have it scheduled to put out various content over time, which I hope will help everyone. So I hope that's been a good market update. And if you need anything, just reach out to our company. We're happy to help. You can email us again at support@copleyfg.com. And I hope to see you in our Mission Valley office very, very soon.